Good morning, options traders. Steve Gans here, and I'm going to start a new series here in the YouTube channel. I've noticed as I respond to questions and things like that on YouTube and other places that many times there's a little bit maybe of a lack of understanding of some of the basics surrounding options and how they work. So based on that, I wanted to do a kind of boiled down what I'll call Options Trading 101. This is going to be a multi-part series that will show up over the next few weeks. They're going to be relatively short in nature each session, probably in that 5 to 7 minute range, something along those lines. And I'll get through, kind of what all we're going to cover here in a moment. But basically, the things I want to look at is today, in phase one, I want to look at the history of options. And then in a subsequent section, we'll get into options terminology, understanding puts and calls in more detail and how they work. And then there's going to be a session on the Greeks. And after that, a session or two using single leg options, the pros and cons of that. Then further down the road, we'll get into understanding a P&L diagram, and then a little bit of technical analysis or chart analysis. And then we'll talk about different types of spreads, a little more, the bull put spreads, bear call spreads, why a spread over a single option, understanding the basics of spreads. And again, these are all going to be in little bite-sized pieces. So then we're going to talk about detailed position modeling and multi-leg strategies like condors and butterflies and things along those lines. And then we'll just talk about general trade structure, knowing your risk, and how adjusting a trade will allow you to shift your risk as your market assessment shifts. So those are the types of things. And again, many of these are going to be broken up into different sections. Like today, I'm just going to do the history of options. Then we'll start into options terminology, and then we'll do a session on puts, and then a separate session on calls. So again, lots of little pieces that'll be coming up here over the next couple weeks, little bite-sized pieces. But the first thing I want to do is talk about the evolution of options trading in the United States. So back in 1872, that's when the first options trading exchange, the CBOT, was established. In 1941, the SEC, Securities and Exchange Commission, approved the first standardized options contracts. Then the CBOE, the Chicago Board of Options Exchange, was established in 73. And then the Options Clearing Corporation is established. Now that's an organization that basically just guarantees the performance of options, how they operate, etc. Then the SEC finally approved electronic trading of options. I was trading around that time, excuse me, and I remember that coming to light for the first time and thinking, geez, how am I going to do this? I'm not going to get to talk to anybody. I can't phone in an order. And then Dodd Frank put in some consumer protections and reform surrounding options trading. So Dodd Frank was a pretty major thing in options trading. Again, that came about in 2010. And it again gave a bunch of consumer protections to options trading, increased oversight of financial institutions in general, and more protections for investors and traders. So that covers the first part here of history of options. In the next section, I'm going to get into specifically call options. How do call options work? And again, a lot of people think they understand this, but I'm going to give you some examples using real estate that I think might drive home not only what an option means, but how the price of that option can get impacted in various scenarios. So we'll see you for part 2 in a few days. Take care.